What's going on, guys? Danny closes deals with PRMG Got Mortgages. Today we have a special guest, Tim Rowan. What's up, Tim? What's going
Just
on?
glad to be here, man.
Yeah.
Like this is a ton of fun.
So-
I flew out from the West Coast, like
Yeah,
I'm
yeah.
3,000 miles away from home, man.
I appreciate you coming in.
I love being here.
Flew in. You went to New York. Then you
Yep.
came down to Jersey to see
Yep.
us. Stopped in. Tell everybody what is it you actually do and who you work for and your position and all that stuff.
So I work for Figure, financial tech company, fintech, using our technology to facilitate home equity lines of credit. Very, very quickly, very digital path of least resistance, let's put it that way.
Yeah.
And what do I do? Well, I work with you and other partners just like that,
Absolutely, yeah.
really, right, to help work on the engagement and really maybe understand the power of the process even more so than the
Sure.
product. Right?
Absolutely. Yeah, absolutely.
Yeah.
So PRMG and Figure, we teamed up. We do the Figure Lightning HELOCs. What is really a HELOC? Because a lot of people don't even know what a HELOC is. They hear the term and it sounds cool, but they don't even know what it is. So what is like a HELOC in your terms?
So stands for home equity line of credit, right? So let's start with the very basics there. And really it's a way for homeowners to access their equity for any number of different reasons, which I'm sure we can dive into.
Absolutely.
Yeah. But that's really
A traditional, like just what a HELOC is.
Yeah, and actually our HELOC, and we can talk about this,
Yeah,
of course, is slightly different than what most people, if people have an understanding of a HELOC, they may be thinking of it from more of an old school or more
Correct.
traditional term, right? Like that interest only for 10 years, adjustable
Exactly.
rate mortgage,
Mhm.
recast, don't have to draw the money, rainy day fund, we call it.
Absolutely.
The original HELOC, if you will, was a rainy day fund. And that's not really what we do,
Yeah.
right? We're very purpose driven.
Let's dive into that. So you guys call it the Lightning HELOC.
Yep.
What is the difference between basically a Lightning HELOC and a traditional HELOC? I know you mentioned one was the interest only, which used to be very common. What is really the main differences between the Lightning HELOC and a traditional HELOC?
So for our process and product, the biggest difference is we do not have an interest-only aspect. And some folks think, well, gosh, I really want the lower payment. However, really when you look at the loan amounts being borrowed, the difference on an interest-only payment versus fully amortizing, meaning the payment is principal and interest,
Right from the first payment.
right from the first payment, they're actually very close in payment. It's really not as big a difference as most people think. And more importantly, it's the security or the safe haven, if you will, of knowing every time you make a payment, you're actually still paying towards the principal of the money owed.
So 12 months from now, your balance will go down.
Absolutely.
A little bit, instead of we're interest only, you're paying sometimes for multiple years and the balance is still the same. You didn't make any progress.
Absolutely. No question about it. And listen, a lot of us remember a time where that was commonplace. That was the only type of HELOC that was available.
Absolutely.
And you might go to refinance your house thinking you're going to pay it off. And shockingly, sometimes people go, well, wait a minute, I still owe the same amount I did 5 years ago.
Absolutely.
So, yeah, we love it for the fully
listen.
amortized aspect of it.
I love it too because I like to explain to my customers, especially depending on the purpose why they use it. It makes a lot of sense because it's very frustrating to pay down a loan and then look at a year from now that the balance hasn't changed.
Yeah.
That's like it beats you up emotionally.
It can be frustrating, right?
Yeah, absolutely.
And so, we love the principal aspect of it. Now, as far as terms, we have 30-year, 20-year, 15, and 10, all fixed and all fully amortizing.
I love it.
So, some folks might want shorter term money, okay, with the higher payment. Maybe that 10 years, the number for them.
And I do know we do offer variable rate too now.
We do.
But I usually try to tell my clients I like the fixed rate because the amount that you're going to save on the rate is not much. And I like to know what my payments are.
The rates may be 0.25% improved, right, on the adjustable. And this, I think, honestly, Danny, we rely on folks like you for your expertise on this topic because the strategy might be if you're speaking with your clients or maybe some of your referral partners, maybe you're having a conversation around what does the homeowner or what does your partner think is going to happen to the Fed rate? And if you come to the conclusion that you're pretty convinced the Fed's going to continue to lower rates, well, maybe that arm is the way.
Correct.
But I think you would agree that's not a decision you make, but rather something you educate to.
I rather educate, let them choose. I will give my advice.
That's right.
But at the end of the day, it's their choice, it's their money. But I always give my advice, what I would do in your shoes. So speaking of getting into these loans, right? What is like the basic requirements as far as like credit, DTI or loan to value, things like that? Like, because I know this is a little bit different than doing like a cash out refi or traditional loan. There's different requirements.
Sure. So completely different than a traditional loan process. That's where the fintech piece comes in, right? And so as far as a qualifying perspective, we will start with as low as the 600 FICO. We have this bucket, I'll call it 600 to 639. Our true core product, as I think you know, is 640 and up, 680 if it's investment property, 680 FICO score I'm talking about. But really, qualifying is kind of simple.
Sure.
And so it's interesting because so many homeowners, anyone that's done a home has certainly had a loan at some point, right? Well, you're submitting pay stubs, you're submitting tax returns, you're submitting bank statements, you're doing all these things.
Sure.
We're not going to do any of that with us.
It's all linked through Plaid.
That's right. We're using Plaid, which is a third-party system in the banking world, by the way, widely used. Not secure, just by us, right?
Secure, safe.
And a borrower is going to link to their bank accounts to verify their income. And some folks think, well, wait a minute. Well, what the tech does is it identifies payroll style deposits, grosses it up is the formula because we know those are net deposits.
Sure.
And says, okay, we verified your income. Move on to the next step, please. And we'll never ask for, once we verified income, we don't ask for additional documentation.
You can't beat that. It's ease of use.
It's ease of use. If I'm being honest, I think it's the way our lending industry looks down the road. I really think this is where we're headed.
But it's funny because a couple of clients, because I did probably like 15 of these last year, maybe more. A few of my clients were like, "Is that it?" I'm like, "Yeah." I was like, "You wait 3 more days and the money will be in your account." They're like, "This seems too good to be true or too easy." I was like, "No, it's a good program we came up with and it works." I say it's not perfect because it's AI driven and all these technology, but 90% of the time, it's a very smooth process.
Here's what I love about it. Even let's just talk about when things derail. Let's assume it doesn't become a smooth process, or maybe you don't automatically receive an offer, as we would call it, right? I would actually tell you, Danny, that's okay. And why? Because you'll get there in about 10 minutes. You know what I mean? And so, so for you, it allows you to strategize and maybe come up with a different strategy, off-ramp it to a different product or process. And even for the homeowner, I tell loan originators all the time, have the borrower start by connecting their bank accounts. Remember, we can also connect to tax transcripts or payroll providers and that type of thing. Even if it doesn't work, the borrower's investment will have been about 15 or 20 minutes. You see what I mean?
And it's free.
That's correct.
And no hard credit check.
That's right. No hard credit check. We do not pull hard credit until which time qualifying income's been verified.
So you have nothing to lose. So it's like, why not? At least to see. I always tell my clients, listen, if you don't like the option, the rate, the payments, you walk away. No hard feeling. It never happened. That's why I said just try it. Compare it to other options or cash out refi because you never know.
Right.
You might say, you know what, this seems great. Let me do it.
Yeah, and as I think you know, and anybody watching knows, the number one use case for us right now, of course, and I think you would agree, is debt consolidation.
Absolutely. We
have a very equity-rich homeowner society currently, however, a very cash-poor society because of debt load, in my opinion, and I think agree. All the numbers would say the same thing.
I agree with you 100%. I agree.
And so this quickly facilitates some relief there.
So you said investment property before, so I want to just touch back on that. Because I was going to ask you that. Sure. This program, so it's not just stuck with primary residence only.
Investment and second homes as well.
Okay.
We reduce the amount we'll lend, meaning up to the value of the home. We'll go up to 70% loan to value. You and I say that like everybody knows.
On investment property.
On investment properties, 85% on primary residence.
Also, 85 is good because a lot of places only do 80.
Right.
So the extra 5% makes a big difference.
And by the way, let's talk about the back half of that real quick. Yeah, we go up to 85 on a primary, and some folks will go, "Oh, you need to go to 90. You go to 95." No. We want the homeowner to still have a protected position in their equity.
We want you to keep some equity.
Absolutely.
We don't want to dry you out completely.
Right.
That's not a good place to be because now when you sell your home 2 years from now you don't want to be negative. You want to have equity. So I wouldn't even advise people to go to 90%.
Yeah.
I agree with you 100%. So from start to finish, right? What does this process look like? If let's say I'm a customer and I want to apply for this loan. What is required from me, and how long does it take, and how many steps do I really have to go through? Like, because I know with a traditional HELOC and mortgage, you got to give all this documentation, and it takes days and weeks and back and forth. The underwriter.
Yeah. So 2 paths here. One, work with you. Danny, right? You can take care of this
for me.
I'm glad to. And what you're going to do is you're going to run what we call an inquiry, and that's going to take you 2 minutes or less. Literally, as you know, that fast. You're going to see what offer they would or wouldn't have in that first 2 minutes. Once that's done, and an email gets sent to the borrower for them to accept the offer, they're going to initially acknowledge the disclosures up front, e-signed, right? They're then going to be asked to add some additional information. They're going to verify their credit. That's going to be any number of different sources. Our most recommended, of course, is going to be connecting to their bank accounts. And literally, we see folks get to scheduling notary within 20 minutes.
That's fantastic.
Right?
You can't beat that.
So then, because of compliance and whatnot, let's say you complete your notary, you then have to wait 3 days rescission, right? That's the rule on primary residence.
Correct.
And then the loan will fund after that. That's why we say the 5-day HELOC.
Yeah,
you know? So,
well, I've actually had people get their money exactly within the 5 days. And
sure.
And it happens more often than not. Like it's pretty if they cooperate and get all the stuff done in a day, which only takes them 15 minutes.
Sure.
The money funds within 5 days.
Well, you've just said something very interesting, and you'll probably appreciate this. I tell loan originators all the time, the rule with our process and product is no different than a traditional loan in the sense that as fast as a borrower will engage is as fast as the process will go.
I have a file now. I'm still waiting for the client to pay for an appraisal. I've been waiting a week. I'm still waiting to send this document, send that. Yeah. So I could have almost been done clear to close with their loan. It's a regular loan.
Right.
But because they're not sending the proper documents, I'm still waiting for information for 3 days. I sent 3 emails.
Right.
They're still not giving me information. I can't close their loan.
Right. And that's being driven by the borrower's action or lack of.
Absolutely.
Right. And so the same is true for us. If a borrower's engaged, it can go so fast.
Yeah. I've seen it go lightning fast.
Yeah.
And, that's why we call it lightning HELOC. It's funny because a guy that used to be on our team came up with this term, and I thought that's what it was called originally, the 555 HELOC. I thought that's what it was called because it made so much sense.
Yeah.
Because he was like, 5-minute application, 5-minute approval, and money in 5 days. I was like, that's clever. I was like, so I've been telling my customers, it's the 555 HELOC. Like, what's that? But this HELOC is able to move so fast. What makes this able to just fund so fast? Like, how is this process able to do it so quickly compared to going to a bank and doing a regular HELOC?
So this may sound a little crazy, but the true magic to it is the fact that we have very little human interaction. This is a system and a software and a process that's built where we're pinging or attracting data, title data, credit data, value data, right? The property value with an automated valuation appraisal report.
Sure.
And it's all done literally in minutes.
It's crazy.
And so very seldomly does it require a human interaction. So now let's compare that to the traditional loan process and certainly historically the traditional HELOC process.
It takes
right?
2 to 3 weeks on average.
Well, sure, because what we know you have to do is create a loan application, collect the income documentation, the asset documentation, open escrow, order title, order an appraisal, submit the loan to said lender, wait 48 hours or maybe more for underwriting. Then you have prior to document conditions, prior to funding conditions, schedule the closing. And 3-4 weeks from now, you're closing the deal. By the way, that process right there is also why the cost to produce a loan
costs more.
That's exactly right, because of all the intervention and hands that are involved.
So it's funny you said that because that was actually what I was going to ask you next. So this loan compared to a traditional HELOC, there's no out-of-pocket cost at all.
There is not.
There's no closing costs like a traditional loan. There's just the origination fee. But even what shocked me when I first started doing these loans is there's no appraisal fee.
Right.
Now, first of all, the appraisal is done within 90 seconds online. So how do you do that and keep the costs from the borrower? Like you don't charge them for the appraisal. How are we able to even do that?
It's all behind the scenes in just the way we're building out the margins and whatnot and the way we price the loans. It's all part of that. It's interesting you bring up, you said very quickly, the only fee we have is the origination fee. And meaning that is the fee charged to the file, but it's only the one fee and it adds to the loan amount. And I've actually had loan originators and in some cases clients say, well, gosh, 2.99% or 1.99%, that seems awfully expensive. But wait, compare it to a traditional HELOC process, and I've done this, where you have a title fee, an escrow fee, a notary fee, an admin fee, an underwriting fee, an appraisal fee. All of a sudden, you realize that one fee we charge is less considerably in a lot of cases than the culmination of all the other traditional fees.
And there's still an application origination fee with those loans.
Absolutely.
On top of all that stuff.
Absolutely.
Which is pretty comparable to what we're charging.
Oh, sure.
And plus all those appraisal alone, it could be $700 on average. You know,
it's really interesting. I'll tell you a story real quick if you don't mind.
Yeah.
About a year or so ago, our CEO reached out to me, and it's one of the things I love about our CEO is he's literally involved at that level. Like he wants to know, he's engaged, and you know, so I love that about him. So his question was this. He said, "Hey, I happen to know someone that just did a 20-year HELOC outside, not with us at the time." And at the time, we weren't offering a 20-year. We do today, by the way. Funny how that works, right? Yeah. But he said, I'd be curious as to how we'd squared up. And I said, well, listen, in order for me to answer that question, could you get me a copy of the closing statement? Which he could. They're friends and close relationship, whatever. That 20-year HELOC was slightly over $9,000 in total costs. And I said, now, if I were the originator, putting my originator hat on for a minute, I would have not done the 20-year, mostly because we didn't have it, but I would have strategized with the borrower to do the 30-year, lot less in cost, nowhere near $9,000. Sure. And I would have advised the client on how to amortize it over 20 years. I'd have given them what that number is, because borrowers can pay whatever they want, right? As long as it's above the minimum payment, you know. And so it's really important to me. It's not just a rate scenario for me, and it never has been, no matter what the type of mortgage is. It's an all-inclusive number. I want to know what the closing costs are. I want to know what the rate is. I want to know. You know what I'm saying?
Yeah.
And so I think the fact that we have just the one fee makes that very simple math, you know, when even comparing it elsewhere.
Well, it's just, you don't have to decipher through a whole bunch of documentation, figure out what do they charge me for this loan.
Right.
Like, it's very simple to read. Here's the fee. And even on some loans with different customers, you guys give different options for origination fees. So to buy down the rate.
That's correct.
And I always go over with the customer, guys, this is the lowest origination fee you can pay, but how long are you going to keep the loan? So that's where I have to come in as a human, where they still need me, is I have to guide them what's the best origination fee to choose. Because if you're going to keep the loan for 12 months, 18 months, 3 years, I do the math for you with a calculator and show you what the break-even point is. Is it worth buying down the rate? And sometimes it's not. Right. But most of the time it is if you're going to keep it for more than 15 months, 16 months. And they're like, wow, that makes sense. I'm going to save $80 a month and I'll break even in 16 months.
Sure.
I plan to keep it for at least 10 years. Why wouldn't I do that? That adds up.
So I'm going to share something. You may not know what I'm about to hit you with here real quick. We'll see. We're going to test you here real quick. A lot of folks don't realize. So let's play this out. I do 100,000 HELOC with us, right? Your Lightning HELOC. With the origination fee, let's call it the total loan amount is 103. Okay. So I'll use a 2.99 origination fee. So that's added to the loan amount. Your total line is now 103,000, but the draw amount is that initial 100.
Sure.
What a lot of folks don't realize is when you have the ability to redraw, you get to redraw all the way up to that 103.
I did not know that.
See?
Oh, so you get an extra little bump there.
That's exactly right.
So if I pay $5,000 down, I really have like $8,000 to pull back out.
That's correct.
That's pretty good to know.
Yeah.
I want to get to that too, because a lot of people don't realize that with this program. So this is where it's like a hybrid.
That's right.
Where a line of credit, you have money you can take, put back. With this, you have a redraw period where you can redraw some of the balance if you pay it down.
That's correct. So number one, every time you're making a payment, your balance is going down. Going back to, again, we're making a principal and interest payment, right? And so on a 30-year fixed, as an example, you have 5 years for subsequent or future redraws.
That's fantastic.
So as you pay it down, you have the first 5 years to then draw the money back. Interestingly enough, there's no cap on how many draws a person can do in a year, and there's never a charge for subsequent redraws.
Wow.
The only caveat is it's a minimum of $500.
Wow. You can't beat that.
Well, it allows the flexibility. So on one hand, you have the security of the fixed, fully amortizing, but you have the open-end aspect giving you the redraw.
Correct, because you never know what happens. You might want to invest in something. Who knows what? You know, it's a good option to have.
Sure.
You don't have to do it, but it's a good option.
Yeah.
So I see a lot of people leading towards HELOCs over a cash-out refinance, especially in the last year or two. Why do you think that is? Is it mostly because of the COVID rates that people don't want to change?
Well, yeah, and there's a couple reasons for it, but existing mortgage rates being the biggest. So I'll share an example with you. I know of a file going right now, mostly because my wife was the originator on it. So closed her first loan, by the way. How exciting is that?
Congrats for her.
So the borrower's trying to position themselves to purchase their next home.
Okay.
The current home they live in, they bought some 5-6 years ago, VA loan at 2.5% fixed interest rate.
You'll never see that again in your life.
Never see it again, right? So they're trying to position themselves to purchase. So what are they doing? Instead of refinancing that out of the 2.5%, they're using a line of credit to pay off their existing debts, to lower their debt load, to better position them for their next purchase, which will be at a higher rate.
Yeah.
Right? We'll all agree.
Absolutely.
But this helps them get to that point, looking at it from a total monthly expenditure, not just mortgage, but what their total monthly expenses are. So when you look at somebody that has that sub 3% rate, sub 4, sub 5, it's really important to understand the impact of blended rate. What do I mean by that?
Correct.
I've run some numbers. I know you know.
I do it all the time.
Yes, but I took a look at a blended rate, and I want to say I used someone that has an existing 5.5% mortgage. We added an 8.5% 30-year HELOC. The blended rate was in the low 6s. Okay? Here's the question. Can you do a cash out refinance at less than that? If you can, probably your better alternative. But you probably can't, right? You know what I mean?
No.
You know, I mean, there's some credit guides, there's CLTV caps, you know.
Yeah, but most of the time you can't. What I do is I like to take if my customer's payment conscious and not rate conscious.
Sure.
That's really all they care about. I try to go over the math and I say, listen, let's take your current mortgage with a Lightning HELOC. Let's see what the two payments combined are.
Sure.
Right now, let's see what a cash out refi, what your total payment would be. And then if you're payment conscious, I let you choose. Okay, this payment is less, or this payment is less, because a lot of times, if you have that low rate, it's better to take the HELOC.
Sure.
Sometimes it's not, and I'm honest. I'd rather be honest with my customers and do what's best for their pockets, because my business is built on referrals and doing the right thing. And speaking of the right thing, a lot of big box stores, the big banks,
sure.
I get a lot of customers from them because, and I'm going to give this tip out. A lot of originators are not going to like me for this. You get paid a lot more money to do a cash out refi.
Sure.
So a lot of these big banks, they tell customers, no, do a cash out refi to change their rate. I don't do that because I'd rather build my business off of trust. So a lot of banks I notice are doing that, and they come to me and I said, no, you don't have to touch your rate. I could get you this program here with a fixed rate for this much,
sure.
blah, blah, blah. And they're like, wow, like the other bank didn't tell me that. I was like, yeah, because to be honest with you, they're getting paid a lot more.
Yeah, listen, it's so important. I have hung my hat on my entire career, 3 words: educate, advise, and strategize. And I have woke up every day believing that that's what my job is to do those 3 things: educate, advise, and strategize with my clients and my referral partners. My biggest fear was always that if I didn't let one of my clients know what their options were, that they might be at a housewarming barbecue party and have a neighbor say, oh, why'd you do that loan? Didn't you know you could do that? I would have been appalled, right? That was always my fear. I just want to make sure the client knows what all of their options are.
Correct.
Educate them enough to where they can make the best decision as to what works for them, not me. Who am I? Why should I be the one making that decision?
I like to get their scenario, and I try to say, hey, if I was in your shoes, because I like to, that's how I look at things, because whenever I originate any type of loan, I always say, listen, what would I do if I was in their position? And why would I sell them something that I wouldn't do myself? Because to me, I can't sleep at night doing that. So I'd rather say, hey, this is what I would do. Here's option A, B, and C. But if I was you, I would do option B. And then I let them choose. And I did my part because I told them what I recommend. But hey, they might want to, some people pick a variable rate with the HELOC.
Sure.
And most of them don't. But I have some guys that are like, I like to gamble.
Sure.
Like, well, go ahead. That's your money.
Yeah,
I don't like to gamble.
Yeah.
I like to know what my payment is, and it's not going to go up. But that's up to you.
Yeah. You know what's interesting on the topic of equity, and of course, I think you're seeing it, you're feeling it, you're engaged in doing it. But this is a massive, massive topic right now. Yeah. The home equity line of credit, the HE loans, numerous different ways to tap into equity. It is probably top of mind for most homeowners these days. Again, I made the comment earlier that homeowners are equity rich currently today. Mm-hmm. But let me ask you a question. This is my opinion anyway. Equity is awesome. Like, I've got $500,000 equity. Sounds great at a barbecue, right?
Yeah.
But is equity liquid? And the answer is no.
No, not until you sell.
In other words, you can't do anything with it. You're either going to sell the house, you're going to do cash out, you're going to get a HELOC, right, to access and make your equity liquid. Then it says the conversation switches to, now what do I do with the liquidity?
What's a smart decision?
Right? Now that's a whole different strategy that you can dive into. But let me ask you a question. if a borrower has that $500,000 equity today, is it guaranteed to have $500,000 equity next year?
The market could crash.
It could decline. It could. I don't think anyone's forecasting crash like back in the 07, 08 days.
We don't control it.
Correct. And so it's like, well, wait a minute. Isn't it better where I have an opportunity to make my equity liquid? Aren't I smart to do it?
Yeah.
Right.
And if you have a way to take that money to make it make more money,
sure.
Why? That's how rich people get rich. You leverage the bank's money. So, why wouldn't you take advantage of that if you have that money sitting there? I'm not saying go blow it on a brand new Mercedes and a vacation.
Sure.
But if you have control and you're smart, and you do your research, you can use that money to do a lot of good things or buy another property or whatever the case is.
Education costs for your children, possibly.
Yeah.
Another big use case we currently see is tapping into equity for the purpose of buying second homes or investment properties. Why not?
Yeah.
Why shouldn't everybody have the opportunity to do that?
So my biggest one now is I teamed up with a couple contractors. A lot of people, because the one-time COVID rate that came around, a lot of people need a bigger home, but they don't want to sell and have a higher rate or buy a more expensive home because prices went up a lot.
Sure.
So they're taking the HELOCs out and they're doing additions or adding pools or all that stuff.
Sure.
And they're putting back into their house to make it the right house for them. And it's cheaper that way. And I just did one now for $170,000. She paid off $60,000 in credit cards, and also did an addition for $110,000.
Wow. Let me ask you a question. Not knowing the market out here in the Jersey world, right on the East Coast, where I'm at on the West Coast in Northern California, right now one of the biggest topics is ADUs, accessory dwelling units, and it's a big topic because everything you just laid out. I have that 3% mortgage. Mm-hmm. I might have a big enough lot. Maybe my parents are aging in place, whatever the case might be, or they need to downsize. We need to care for them. Well, the affordability aspect of me adding an ADU onto my property, you see what I mean?
Way cheaper.
Way cheaper. Uh-huh. Just so that's another big use case that we see: home improvement, 100%. ADUs. We're starting to see, at least on the West Coast where I'm at, we're starting to see more of a trend of entire family units living.
That's amazing.
On one property. Really.
But keep your family close, keep an eye on them,
how else do we deal with affordability?
Yeah. It's a smart way to do it, to tackle it, That's smart. I have a lot of customers that do it just to consolidate credit cards debt because, listen, it happens, right? We all go through life. You get divorced, somebody gets sick, you don't have insurance, whatever. There's expenses that come up in life where we can't control life. But I tell my clients, I don't want to see people get back to a hole, but I go over their payments of their credit cards. And I add up all their minimum payments. And I ask, what's your interest rates on these products? 30%, 20%? Yeah. I was like, so why wouldn't you want to get a HELOC for 8% or whatever it is, whatever the rate is that time, and pay it down? But I tell them, you have to be responsible and not build these credit cards back up, or else I don't advise you to take this loan.
And it's a discipline play, right? And listen, you and I, we've been doing this a long time, and we can only give advice and strategize as best we can. We can't actually manage that for them other than to just advise them accordingly. But I'll tell you that the transaction I mentioned a few minutes ago that my wife did her first HELOC, right? Those homeowners are paying off all of their debt, which is currently costing them $1,600 a month. And their total net savings, because of the new payment on the HELOC is $300 and some dollars, they're saving $1,000 a month. That's real money. Yeah. Now comes the discipline part. Not running the credit cards back up. And what do you do with the $1,000? They're positioning themselves to apply it to a new purchase of a mortgage. All we can do is advise them on it.
Yeah, well, but I want them to do the right thing. I try to, I have a similar situation. My client is spending $3,300 a month in credit cards and loans.
Wow.
The HELOC, I priced it out for them, is going to cost them about $800 or $900 a month. That's a swing, and they're going to save $2,400 a month. They want to buy a house in Florida eventually. That right there will cover their mortgage.
Sure.
So, and their debts will be paid off without the interest. So now they're going to be paying a lower interest. I said, then when you sell your house, they have equity in their house now of like $250,000.
Sure.
They'll still have over $180,000 after the HELOC. I said, when you sell your house, you can still pay the HELOC off and still walk away with $100-something thousand as a down payment and buy the house.
Sure.
When you decide to move in 5 years.
Yeah.
And so they're like, that makes sense. I was like, you're paying $3,300 a month, just minimum payments
Right.
That's not even knocking out
right.
the debt. So that debt's never going to go away. So
Yeah.
to me, that's a no-brainer. I said, but you have to be responsible. Put the cards in a drawer. Use one card. Just use it here and there. Pay it off. You cannot get in that habit of spending, because now you're gonna have that HELOC for $100,000, and you're gonna build up your credit cards again. What was the point?
Well, and again, that you're spot on, and it's like it'd be great if we could actually physically manage that for every one of our borrowers, right? But all we can do again is advise them and help them as best we can.
Absolutely.
So make sure they're staying on course, if you will.
Yeah.
Absolutely. Through that. But listen, debt, it is our number one use case.
Yeah.
Right now, because
100%.
Folks are equity rich and strapped with debt. It's a problem.
Yeah, and I think this is a good tool if you use it properly.
Sure.
Like I said, I always try to give my clients the right advice because I don't want to see them go back into a hole, and that would kill me because I care about my clients. So to me, it matters. I try to give them the most education before they do it. I tell them it's a good choice, but you need to be smart after you make this choice.
That's right.
Listen,
first lien, second lien, third lien positions, the process and product that you guys have, it's rock and rolling.
Yeah,
you guys
I love it. This is my favorite product to push, and honestly, my clients love it because it's easy. I really enjoy it. So listen, I appreciate you coming down.
Oh gosh, Danny, I love being here, man. This is fun.
We're gonna go grab some lunch and get you back on your plane.
Yeah.
But I appreciate you coming down, and hopefully we'll do this again sometime.
You got it, Danny. Thanks, man.
Thanks, man.
See you.
Thank you. Cool. That was good.
I thought that was great.
That came out great. Yeah. And I'll chop it up.
Yeah.
Yeah, that came out really good. Yeah. And didn't stop recording, so